Here is a brief revision for oil and gas taxation. If you care to watch, the oil sector provides for 95% or more of Nigerians' foreign exchange earnings and budgetary revenues. So it's a very important topic in taxation. Now, the oil and gas sector has various activities, majorly divided into three: the upstream activities, midstream activities, and downstream activities. The upstream activities covers extraction, refining of crude oil. The midstream activities cover transportation, distribution, and the downstream covers sales, marketing. So all those Shell, that's the upstream activities, right? And these upstream activities pays hydrocarbon tax and company income tax. The midstream pays only company income tax, and the downstream pays company income tax only. So it makes sense that oil and gas taxation here focuses on the upstream sector. So we're going to be discussing only the upstream sector majorly. Under the upstream sector, things are done differently. Like I said earlier, the tax paid is hydrocarbon tax and company income tax. Let's talk about hydrocarbon tax. This has replaced the petroleum profit tax that was 85% in the past, okay? Based on the Petroleum Industrial Act 2021, the hydrocarbon tax rate is 15% if the company holds a petroleum prospecting license, okay, and 30% if that company holds a petroleum mining license, so they are mining already. So the rate is 15% and 30% depending on the license they hold. So you always pay attention to the question. It will tell you, these future questions will tell you the license that they hold. And I said the upstream activities also pays company income tax of 30%. Now, this is because of expenses that are onshore. So in these upstream activities, like I said, it's majorly extraction and refining, but it's not all these activities that are offshore. Offshore is inside the water, continental shelf. Some activities are onshore, like all these admin expenses. So because of that, there needs to be payment of CIT, and you understand that in the question. The next thing we'll talk about is the basis of assessment. So oil and gas tax in this upstream sector is paid on actual year basis, and it starts in March. So for 2024, that tax for that tax year 2024 is paid in 2024, not starting in January, but starting in March up until February of the next year. So you skip January and February of this current year 2024 to start in March, okay? And the taxes you pay are actually estimates, because in the 13th month, there's something we call the 13th month installments, where you make up for any underpayment or overpayment. So the taxes paid are usually in estimates. But the important thing you should notice is that the basis of assessment is actual year basis. Let's talk about the act. The act regulating the upstream sector is the Petroleum Industrial Act, as opposed to the Petroleum Profit Tax Act in the past, that PPTA. So all that is scrapped. Let's talk about the authority. The authority responsible for regulating the activities in the upstream sector is called the Commission for short. It's actually a long name, the Nigerian Upstream Regulatory Commission. So it's called the Commission for short. And for the midstream and downstream, it's called the Authority for short. It's also the Nigerian Midstream and Downstream Regulatory Authority, or something like that. So those are the important things you need to know. Let's talk about the approach to calculate now the hydrocarbon tax in this upstream sector. So the approach you can use is the income approach or the net profit approach. The income approach is pretty common, where you have all the income. We're trying to calculate tax, right? And to calculate tax, all you need is income and expenses, because tax is charged on profit. So the income approach is where you assemble all the income, and then deduct all the expenses. Of course, it's not as easy as I'm saying, because you have some allowable expenses and disallowable expenses. Then you come up with your taxable profit, and then you place your tax on it, right? Now, the net profit approach is where it's already deducted and you have a net profit. Then you need to adjust that profit, like add back, deduct, and then you now get the correct taxable profit. Maybe you've deducted depreciation, you need to add back. Then some variables in this topic, like some terminologies you need to understand that should be clear to you, is CPR. It's cost price ratio. So it's a restriction of cost to 65% of gross revenue. We'll solve an example so you understand. So the concept is that tax should not be avoided So the motive for this CPR is for tax to not be avoided, due to huge expenses, because the oil and gas sector, they used to have huge expenses. So the tax authority has tried to restrict costs to 65%, except from 5 expense heads: royalties, rent, NDDC, host community, and environmental remediation. So another thing you should understand is allowable expenses. What are those expenses that are allowed under this upstream sector? Rent, royalties, approved donations, repairs, tangible drilling expenses of the first exploration well and first 2 appraisal wells. Okay, so you need to note that stamp duties. Then you also need to understand disallowable expenses, all those information acquisition costs, bank charges here is allowed, bad debts, litigation, interest paid on loans, and all of that. Also, we need to understand capital allowance. So let's just go straight to solving a question, because this is like an exam revision for those that have read for the exams. I hope you registered for tutorial center classes. Is important. It's very important. I have to state it here that this channel is not a substitute for your regular tutorials. Okay, we don't have a contractual agreement that I will take you. You did not pay me for tutorials, so please go for tutorials and stop waiting for any stranger online to give you free tutorials. Please, everybody has things they are doing with their lives. Okay, and something about taxation is that the laws keep changing, so it's important that any diet you choose to take, it just give you all you have, and pass it. Petroleum Nigeria Limited, located in Ondo Town, holds a petroleum prospecting license. So that tells you they are paying 15% because they hold a prospecting license. The audited financial statement for 31st December 2023 year end is shown below. Compute the hydrocarbon tax, companies income tax, and tertiary education tax applying the Petroleum Industrial Act 2021. You have the following details. That's the audited financial statement. Chargeable oil sold 48 billion, because we have thousands abbreviated up there. Chargeable oil disposed of 9.9 billion. Other incomes 20 million. Now the operating expenses, you have rent, royalty, host community, and NDDC. Bank finance charge. Okay, I didn't talk about what NDDC is. It's just like a government agency. It's Niger Delta Development Commission. It's a federal government agency. It was established by Obasanjo in 2000, I think, and the goal is to develop the oil-rich Niger Delta region of Nigeria. So that's what it's all about. So those host community, government remediation, it's all expenses to develop those communities, the areas around that Niger Delta where oil is extracted. So that's just it's like an expense head. Okay, so we have bank finance charge, depreciation, penalties and fines, other expenses. Then you have the profits before tax. So that's basically a deduction of all the expenses from the total income I read in the previous page. Then the additional information, the Commission has approved a production allowance of 2,316 million for the company. The company has unrelieved loss of 2,896 million. Number 3, the capital allowance for the period is 10,584 million. The recouped expense brought forward is 6,950,400,000. Other expenses are all tax deductible. Then capital allowance for administrative operation brought forward is 7,158,000, and for the year is 1,390,080,000. Solution: Owepo Nigeria Limited. Computation of hydrocarbon tax, company income tax, and tertiary education tax for 2023 years of assessments. So you put your currency and it is in thousands. Okay. Income: chargeable oil sold 48 million, actually 48 billion. Okay. Chargeable oil disposed, you put the amount there. Other income. Then your expenses, the ones that are not restricted to CPR. I had explained earlier that CPR is the cost price ratio. It is simply the restriction of expenses to 65% of gross income, so that these petroleum companies will not swallow all their taxes in expenses. You'll see the reason as we solve. So the first category of expenses you want to deduct here is the ones that are not restricted to CPR. And I already told you, we have royalties, rent, host communities, NDDC, and the government remediation. In this question, they gave you rent, you deduct it. They gave you royalties, you deduct it. They gave you host communities and NDDC, you deduct it. Pretty straightforward question. And this hydrocarbon tax, Petroleum Industrial Act is quite easier than PPT. Okay, so just keep an open mind. So as you're putting out all these figures here, you have to report for hydrocarbon tax and company income tax, because we know upstream activities pays hydrocarbon tax and company income tax. So you're not computing, you are just reporting. So this table by this side, you are reporting for each city and reporting for CIT. So some expenses are allowable under this CIT that are disallowed here. Some are allowed here and disallowed here. That is why you are reporting for both. Also, there are different tax authorities in charge of HCT and CIT. So that's why we are reporting for both of them. So now, under HCT, the total income made is 57.9 billion, and under CIT, that is also what is made. Now we are computing the expenses. The total expenses that is not restricted to CPR, that is, restrict every other expense to 65% of gross income, apart from these 5 that I gave you. And out of that 5, there's only 3 that showed up in this question. So you would deduct them. So this one's meaning that you are providing 100%. That is, they are 100% allowable, okay, under HCT. They don't occur under CIT. They are not related to the company, to the admin expenses. These are the real petroleum expenses, like under refining and extracting, the main upstream sector. But even in that upstream sector, there are other activities that are not relating to the main petroleum activities. Do you understand? Like their admin staff, they are paying for rent of offices, they are paying bank charges, all those things. How would you separate them? That's why we are reporting for HCT and CIT. Now, the next category. Now, the next category of expenses are the expenses restricted to CPR, that is the cost price ratio, which is 65% of gross income. So you check for other expenses apart from those first 5. You have what? Production allowance. It is in your additional information, 2.316. Capital allowance in PPT, sorry, not in PPT, in oil and gas tax upstream sector, capital allowance is under allowable expenses. Okay, you know, in CIT you do your capital allowance later on. You see that on this page if you can already see it. You do that later on after adjusting for accessible profit. So here your capital allowance is under the category of restricted to CPR. Okay, so it's under expenses. Basically, the easy way to do it is to divide your expenses into the unrestricted category and the restricted category. That is those first 5 expenses, then others. So look at how we do it. Production allowance 2.316. Capital allowance for the period is given in your additional information, 10.58. Then capital allowance to be recouped, that is the one brought from last year, 6.95. Other expenses. Now, these other expenses is in your financial statements. They were not clear whether these other expenses relate to just hydrocarbon tax reporting or company income tax reporting. So we are going to treat it under both. It does not mean you are charging twice. Like I said, you are just reporting. So when you are reporting to the authority for HCT, you will consider it. When you are reporting to the authority for company income tax, you will consider it. Now, can you see why there is a restriction? Look at how ridiculous this 40 billion other expenses is. What is it? What is the explanation behind these other expenses? We don't really know, but let's keep solving. So the total expenses restricted to CPR is 60,394,400,000. Now, that's what should come out of here, of this income normally. You know, this is the first category of expenses. Then this is the second category of expenses, right? But you have to restrict it. Don't charge it all. That's why here you can see CPR restriction. This is the total. Then you have CPR restriction, 65% of gross income. What is your gross income? 57 billion plus. So you restrict it, and that will restrict it to 37 billion. So if income is 100%, expenses has been restricted to 65% of it. You see, it makes more sense, because look at this total expenses. If it won't pass the income that the company made, so the restriction is very important. So this is what you would charge. Do you understand? Now there is an unrelieved balance. Look at it, 60 minus 37. That's the unrelieved balance. You carry it forward. Okay, so that's it. Now don't forget to put this 40 billion other expenses under reporting for CIT. You can see that when you are reporting for CIT, you have the income. The tax authorities will see your income. because we have to calculate company income tax also now. Yeah. So they will see your income. Rent is not applicable here because this rent, these royalties, these host communities relate to the main petroleum activities except if otherwise stated. So it doesn't have any provision here. All these also, production allowance, capital allowance, recoup, they all relate to the main petroleum activities, which falls under HCT, and it has no provision here. But other expenses is vague. There's no clarity there. So it relates to both HCT. Look at it here. It relates to both HCT and CIT. Look at the portion here for CIT. Look at the portion here for HCT because it has been restricted. Then the next category of expenses is the company income tax allowable expenses. We are done with the petroleum allowable expenses. Now the company income tax allowable expenses. Okay. The first one is bank charges. Actually, that's the only one given in the question. In the financial statement, bank finance charge 1,737,000. Now, after setting off income and expenses to give you your adjusted profits. You know, these adjusted profits, accessible profits, taxable profit are three very important variables to get your tax. But once you get your adjusted profits, at least you can work your way down to the rest. So you have your adjusted profits reporting for HCT and adjusted profits reporting for CIT. It doesn't mean you are charging anything twice. It's just the reporting that we are differentiating so that we can charge our tax, okay? Now, loss relief. The reason we are doing loss relief is because to move from adjusted profit to accessible profit, you need to get your loss relief. You know that, right? So the loss relief was put in the question. Additional information as 2,896,000,000. The company did not specify whether it belongs to petroleum reporting or CIT reporting. So because of that, you charge it under the both of them. It doesn't mean you are charging twice. You are just reporting. Does it make sense? Because you're trying to get what a taxable profit should be. So it doesn't mean you are charging twice. Just in case somebody is thinking that, am I charging twice? No. Accessible profit, you derive that after you've deducted your loss relief from your adjusted profit. So when you deduct that, you get your accessible profit. Now, capital allowance, because between accessible profit and taxable profit is your capital allowance. That is under CIT. In PPT, sorry, not PPT, in upstream oil and gas, that is when you are calculating hydrocarbon tax, HCT, your capital allowance has been charged here. Okay, it's been charged as an allowable expense. So in the question, they give us the unrelieved capital allowance brought forward in your additional information as 7.1 billion. Then for the year, they give it to you as 1.3 billion. So the total is 8.4 billion. Now you restrict to 2/3 of accessible profits. This is the accessible profit under CIT reporting. So 2/3 of that portion will give you 5.2 billion. That is what you should charge. Don't charge this total capital allowance brought from last year and the one for the year. Don't charge it. You are restricting. That's the rule. Restrict to 2/3% of accessible profits. You know that rule, except for agriculture and manufacturing companies or something. So this is what you're going to charge, 5.2 billion. So look at that here. But we're also writing it here so that we know, the trace, how we got the figure and what we are sending into next year. So this is the carry forward balance of capital allowance, 3.3 that you carry to next year. So you close it here, but you put the figure here. 0 is here. And then what you're actually deducting, the capital allowance actually deducted is this. Look at what they gave you in the question, 7.158 and 1.39. But look at what you actually did. So you see that you have to understand the rules in taxation. So this is your taxable profit. Very easy question, actually. There are 3 questions, but it's just one I can solve. Then hydrocarbon tax is at 15% because they hold a petroleum prospecting license. If it was a petroleum mining license, they would pay 30%. So 15% of the taxable profits, can you see, under HCT. This is the hydrocarbon tax reporting and company income tax reporting to different tax authorities. Okay, so 50% of this will give us 1,086,000,000, blah blah blah. I beg long figures. Then 30% of this one will give us this. Imagine if you didn't report for CIT, how would you know what to base it on? You won't know. You can be basing it on the one for HCT. It doesn't make sense. It doesn't make sense at all. It doesn't. So TET is 3% of accessible profits. Okay, so 3% of your accessible profit. This is the accessible profit here, not the taxable profits. This is the accessible profit. So you get 608,256,000. So that's the end of the question. I wish you success in your exams or whatever you're using this for.